Welcome back to Accounting 2. We're in Chapter 14 talking about corporate worksheets. So we have started up our business, and usually January 1, or our business continue to run January 1. And we do all the stuff we've done so far. So we sell stuff on account, we acquire raw materials on account, we pay cash for expenses, we pay cash for raw material, we pay cash to employees in the form of payroll, we send taxes to the government, we pay cash on account, we buy stuff on account, we receive cash from sales, we receive cash from the selling of stock. Not often, but we do. We receive cash on account. We return stuff we don't like. People return stuff to us we don't like. We do this all year long. Right? So we kind of jump to the very end of Chapter 14, and we've made money. Right? Revenue minus the cost that went into the product, minus the expenses, and we got some profit. Right? So we're going to need to figure out what are we going to do with that profit. So here's where we got to get you in the textbook. I need you on page 404. I'm going to talk distributing corporate earnings to stockholders. Now, a little bit of a flow chart on how a corporation works. We decided to start up Clem Corp. We went to Deutsche Bank to go sell those shares of stock for us. They went to the stock market. They sold the shares of stock for us. They gave us our $500,000, and we know who our owners are. We tracked who actually owns the shares of stock, but it isn't necessarily me, right? So the shareholders, they're going to elect a board of directors, and that board of directors is going to oversee the company. This board of directors will hire the CEO or the president to run the company, and the board of the directors is the one who's going to declare whether dividends get paid out to the owners. Stockholders don't get to decide if they get to take the profits from the company. Right? The board of directors is a group that decides. Now, if I'm one of the major stockholders and I elect the board of directors and we make money and I think they should be paying it to me and they don't, well, then the next time around, maybe I elect somebody else as a board of director. So that's a little bit more high-level finance kind of stuff. But in general, the owners of the company don't get to decide if they get to take the profit. Now, if I've sold 10,000 shares at $50 a share and my company does well, the value of my stock will go up. That's simple supply and demand. If the company does well through performance or is demanded more than people want to sell it, the value goes up. You look at now kind of spring of 2020 and you're seeing the value of companies going down. Well, there's a lot more sellers than buyers. Either one of those transactions do not have a direct effect on the company running day to day. Right? I sold my 10,000 shares of stock at $50 a share. That's done and gone. Right? The cat's out of the barn there, or the cow's out of the barn there, and the horses are out of the barn there, or whatever's out of the barn. Something ran out of the barn. Right? Can't get it back. That's gone and gone. Not going to deal with it. Higher level accounting and finance courses, that means something. For us right now, we're just saying that transaction's gone. Value of the stock goes up, doesn't change what I do. Value of the stock goes down, doesn't change what I do. Right? That's the owner's problem. Owners, in turn, again, don't necessarily get the profits unless the board of directors says you get a chunk. So let's talk about the board of directors saying you get a chunk. So the stockholders' equity accounts used by a corporation, we talked about this capital stock, right? The shares that were issued, the 10,000 shares at $50 a share. We have this account called retained earnings. This is if we make a profit, because we cannot go back and say we sold a different number of shares or we sold it at a different price. This number really can't change unless I choose to sell more stock. So any profits are going to go to retained earnings. It's almost like our old school accounting one capital account is kind of broken into two pieces. The sale of initial stock and then the profits. Well, retained earnings is the profit part. Dividends would be us giving away that profit to the stockholders. And then we still have income summary. So the board of directors has to declare a dividend. And they'll usually declare it and then wait a month and then pay it. So this company called Hobby Shack has a board of directors, and they declared that every 3 months they're going to pay a dividend. Well, in this 3-month chunk of time, they're going to pay out a $2 per share dividend. They had issued a total of $2,500 in capital stock in the past, so 2,500 times 2. They're saying, hey, we are going to create a $5,000 liability. We're going to owe our shareholders $5,000. We're going to pay it to them, but we're going to pay it to them in a month. Give us some time to kind of get that cash together. So you notice it was declared a dividend. It wasn't paid cash yet. Or you notice that your memorandum was your source document. So dividends, which is the owner's equity account, we're going to set up a debit to dividends, just like drawing, opposite of capital stock, opposite of retained earnings. That's why it's a debit balance. And then we created a new liability called dividends payable. This is our promise to pay the owners at a later date. Just like accounts payable is a promise to pay our vendors at a later date. So the month comes and goes, and now we got to cut the check. So this transaction, finish up, write the date, write out the accounts that are getting changed, write out your memo, debit amount, credit amount. Again, old school, 2-line general journal entry, nothing new or fancy there. Now we got to pay that dividend, right? We've declared it. We've created the liability. Now we're going to set the liability to 0 and pay off the debt we owe. So here we got January 15th, paid cash. Again, paid cash clues me in that I'm writing the check for quarterly dividend that we declared back in December. We got to write a check for $5,000. So cash credit, that's fairly obvious because we're in the cash payment journal. This is Hoffman writing the check. So now we got to do the debit to what? Should we do the debit to dividends? Well, we've already declared that we're going to pay the owners $5,000. So if we did this to dividends, that's like saying we're doing another $5,000. So it's not dividends. It is zeroing out the liability called dividends payable. So debit to dividends payable, credit to cash. So here is an example, T account, old school. Looks like we've been declaring them over here, dividends on the credit side, and we've been paying them, usually about a month later. Well, here we declared this old one. Now we're paying it January 15th. Here's our cash credit, January 15th. So pages 404, 405, 406, 407. When I ask you to go ahead and do 14.1 work together, 14.1 on your own, pretty straightforward. Declaring the dividend and calculating per share and how many shares, and then writing out the checks.